Thank you very, very much for joining us for this conversation today, talking about corporate actions, a team sport. Now, the aim of this conversation is to be able to put some details around essentially the true cost of all of the inefficiencies that we face in our corporate actions kind of industry structure today, and to put them in, not only to put some numbers out there for you, but also to put them into some specific context so that over the next kind of 45 minutes, you can come away with some really actionable insights that can help to direct your kind of traffic, if you like, in the next year or so. So to do that, it's really fantastic to be able to have some brilliant panelists with me today. So my name is Barnaby Nelson. I run the ValueExchange. We're a market research firm, passionate about corporate actions, amongst other things. And it's really great to have Tim Lind from DTCC here today, and Matt Moseley from Goldman's here today, running asset servicing globally, to be able to actually really share your respective decades of experience on this. So the kind of spoiler alert, this will probably turn into a group therapy session very quickly. But thank you guys for joining.
Thank you, Barney.
So today, what we're going to do is walk you through some of the research that we've been working on in the last several months with Tim and with the DTCC team to start putting some cost information around corporate actions in the US specifically. And then, as I said, what we're going to do is after that, we're going to come out, we're going to talk through the numbers a little bit. We're going to ask you what you think. So brace yourself to tell us whether you think we're on the right track or not. And then we're going to start going into some specifics around the themes of what we can do about this and essentially where this all goes. So what are the numbers behind corporate actions in the States? So I think if you actually take a step back, pretty much there's numbers that stand out for us as being most striking, if you like, are the fact that an average corporate action in the States, a voluntary one, costs about $34 million a year to process. And I can guarantee most of you, if you haven't seen that number already, will say, it can't be that. No way. A number that you'll probably you'll have even more skepticism about is the fact that when you actually rub all of that together on an industry basis, you're talking about $58 billion of costs of corporate actions in the US alone on an average year. So, the numbers beg a belief, frankly. But those, if you only take away two things from this kind of quick intro, it's the $34 million of corporate action costs for in a single event multiplied out by into $58 billion in a year. Now, why is that meaningful? I mean, it's a lot of money, frankly, but in case you wanted a bit of context, that equates to about 5 basis points of the US capital markets. So, for me, if you actually wrap that around, generally speaking, we talk about the total expense ratio of a fund as the way that most of us manage our kind of costs as individual investors. It's pretty much, if you think the average TER of a US fund is about 80 basis points, that's actually the same as this cost, which is quite interesting. So if you think about the cumulative costs of running a fund industry in the US, we're talking about portioning this obviously in different places, but ultimately we're talking about roughly similar quantum. So whichever way you cut it, it's a lot of money. And why is it? I think for me, one of the things that, obviously that number is we'd like to think reasonably well founded on logic. We've spent about a year building it. And essentially the way that we've built that number up is across two kind of key vectors, if you like. One is the fact that if you think about a corporate action in the US, not only does it take a few steps in order for it to actually get into the CSD, so into Tim's world at the DTCC, but it also then passes through anything between 10 and 15 different counterparties and service providers on the way out to a beneficial owner. So whether that beneficial owner be a mutual fund or a pension fund or anything in between, essentially you have a lot of organizations touching a single event as it goes out. So if you think about it, a corporate event for example, I mean, a dividend, it has to go to the DTCC participants. So either the prime broker, one of Matt's team has to touch it, or a local custodian has to touch it, a fund accountant has to touch it, global custodian, and so on and so forth, all the way through all the different steps of the chain. A fund company, a fund trustee, a fund manager, they'll all have various roles to play as it gets out to basically to the beneficial owner. And of course, the challenge with that is that it's not just one person in every organization that touches an event. You have that many layers of organizations, but then you have within the organization, we reckon, depending on the type of event, somewhere between 8 to 12 different essentially hands that have to touch, or functions that have to touch a corporate event. You can see on the right-hand side what kind of things we're talking about. But depending on the event type, somebody has to obviously capture the event, or a function has to capture the event. It has to often be enriched, then has to obviously be reconciled. Then you have to rub it against the entitlements, and so on and so forth. You have to manage the calendars around it. So essentially what you end up with is kind of like a grid of basically multiple organizations times by multiple people in those organizations, which, believe it or not, ends up to about 1 million people touching a corporate action on the way through. And so you can see on the left-hand side, you can see the kind of numbers that we're talking about in terms of the organizational touch points. But for a single US corporate action, as I said, there's about 1 million hands have to kind of get on it. Which frankly, will probably have 2 million hands, given we've all got two. But ultimately, it's there's a lot. But I think ultimately what we're really saying is that there is an enormously human element to this. Now, at this stage, I think normally we've had the pleasure of debriefing with a lot of firms in the last little while about this. And obviously the first thing that people say is, no, hang on, that can't be right, because not every corporate action is touched. A dividend, will go through pretty much straight through to at least a 90% degree STP. So just to pause for a second in terms of where that million hands turns into $34 million of corporate action costs in a single event, there's an awful lot of things that we haven't included. So what we have included is the cost of time. So as you can see here, we assume that the average kind of person that we're talking about is a fully loaded headcount cost of about $80,000 a year. We're talking about actually excluding about 90% of dividends and 90% basically on the basis that they're STP. And as you can see, we're excluding pretty much most coupon events, because of course those do pass pretty much rapidly through the system. But when we talk about issues that pop up in human intervention, you can see that we're talking about somewhere between 5 and 30 minutes spent on any one event. Just in terms of those various tasks, in terms of validating, verifying, and so on and so forth. We're assuming that basically about 5% of those of the events that pass through trigger some kind of exception or manual or error. And you can see, essentially, we're talking about, several thousand corporate action events every year, and then an exponentially bigger number of coupon events every year in the US. But most importantly, all we're talking about in our $34 million number is basically the time cost. So we're not talking about, the time cost of moving a buy or sell order, it's a long position through the system. So we're not talking about securities lending and manufactured dividends. We're not talking about collateral and underlying events on collateral and reconciling that, depository receipts, structured products. So we actually excluded a lot of the really messy stuff. And we're also excluding the system costs, the data feed costs, and the allocated costs. So essentially, that $34 million number, you can kind of get a sense of where we're going. Is not only have we gone to great lengths to make sure it's quite believable, I think there's a very likely chance that it's being significantly underreported. And so, so for me, what really is hopefully you can start to see, even from a quick intro, that when we say $34 million, it's actually, anecdotally, first thing that always happens, people say, no, can't possibly be. After about 5 minutes of going through this, people start to say, maybe, possibly, I start to see where it's going. And obviously, therefore, it triggers the question, okay, if we swing around to the $54 billion number in terms of the total market costs every year, how much of that could we actually really make a dent on? I mean, at the end of the day, if you had the most perfect processes and technology, it would still cost us money. Our estimation is that through the realization of some of the industry work that we'll come on to from Tim's side, through the extra kind of surety and validation of events, we think that it's about $15 billion up for grabs in the US market in terms of efficiencies to be had of that $54 billion number. So essentially, we reckon that basically just through avoidable costs, which we classify as things like people having to actually get in and revalidate an event, supplement it, so on and so forth, and then through the cost of errors that they trigger, we reckon about 15 in $58 billion. So about a quarter-ish of costs could be removed if we really got our act together. Just anecdotally, that would be about $250 for every single investor into the American capital markets if we got this right. So that basically goes back to your pension. So that is the numbers. So as I said, chances are you've dialed in, either you fully discounted them and thought this is going to be rubbish, or you might be curious and thinking, okay, so let's see what this really means in practice. So Tim, your perspectives then, maybe we've been talking about this a lot. Maybe let's just start with what you thought this number was going to be even before we started doing the calculations, and then how you feel this is playing out now as we start to look at these for real.
You bet. Thanks, Barney. And, I reflect on when we got together to talk about this maybe a year ago. In that first discussion, reading some prior research that ValueExchange had done in asset servicing and corporate actions, I thought that we might be understating some of the costs associated with the fragmentation of how information flows like you were describing. We typically imagine the cost of corporate actions based on the staff dedicated to that function. And obviously some of the risks in case we get things wrong, right? We all set aside some money to write checks when things go bump in the night. That's typically how we imagined the cost. But given the wide-ranging impact, it seems that we are all in the corporate actions business somewhere. Index administration, portfolio accounting, sec lending, every function, as you guys have articulated internally within the firm, are impacted by these corporate actions. And so when we got together, I was really interested in you guys advancing some research that was quantitative, that was, as you just went through, based on time allotted to each process, a transparent methodology that could be open to some type of peer review, which really I think is the basis of this webinar. And I encourage people to read what Barney and Martin and the ValueExchange team has put together and pull it apart and see if it represents some of your experiences. But once you did that, Barney, when we looked at the model and all the interactions, and then the bottom line, frankly, I thought you guys were mad. It's just too big, especially the 34 million per event, and then multiplying by the types of the number of events that we see. But then we started to look at it from our own perspective as a CSD. We have more than 200 different direct participants of our settlement infrastructure. We interface with more than 10,000 issuers and agents above us. Each one of those participants serves as an agent to 10,000 underlying, sub-accounts, other regional custodians, sub-custodians, asset managers, and the list that you just showed of intermediation. We have clients that see 11 different layers of intermediation between issuer and investor. So when you look at all of the actions, the actors that this data flows through, when we hit enter on a corporate action, it goes 200 ways. Once it goes to each participant, it goes 10,000 other ways, and that's a conservative number, meaning every event triggers 2 million different alerts. If we have to send a replacement or recalculation, there's another 2 million. If it's wrong, it comes back 2 million different ways. And that's just between institutions, not the functions within those institutions. Your multiplier, I think, by 11. When you look at the cost of interacting, typically emails. There is no automated way to propagate the impact of a corporate action within the enterprise. And the cost per email, we had some clients that estimated between $50 and $100 per email they receive related to a corporate actions inquiry. We have some firms that are getting something like $90,000 a month. That translates to $80 or $90 million just in reading emails, Barney. So when you start to build it up granular, the numbers are still crazy. but I'm having trouble arguing with you.
Yeah, which is a frustrating position for you to be in, no doubt, Tim. But Matt, from your perspective, I mean, I think, if me as I was just kind of talking through that kind of grid, if you like, you obviously from the Goldman's perspective, you are the agency broker, you're the prime broker at the depository. You're also essentially acting in a kind of global custody perspective. You're also the asset manager. How does this, I mean, so you're on the receiving end of a lot of this, I guess, is what I mean. How does this stack up for you in terms of kind of reality check?
Yeah, I mean, I guess similar to Tim, like initial sticker shock. I mean, 34 million is significant by anyone's measure. Like it's a very striking figure, but frankly, it is not unbelievable. When you start to think about the cost of the people, the cost of the data, the infrastructure, the regulatory capital, like this long list of factors that drive cost in our business, like it adds up extraordinarily quickly. I would also comment with the number that while there could be some debate on the absolute number, maybe a little bit of debate on the methodology, I think something that we can probably all quite quickly agree on is that there is a ton of inefficiency in the life cycle, right? And having some at least directional dollar number on that, I think is incredibly helpful in that until you can really measure something, I think in a meaningful way, and most people like can scale and understand dollars, like I think it can be hard to get attention on where some of the opportunity exists, and then also start to demonstrate the so what. So if we do spend some time on this, some of the things that I think Tim are going to talk about, the DTCC are talking about, like if we can start to deliver on those, like what's the so what for the industry? Why should end investors care? Why should fund managers care? So I think when we start to think about it in those terms, like it's an incredibly helpful bit of research, and I think certainly helps set the stage for increasing the focus on some of these challenges and why we should be investing.
Yeah, no, brilliant, and thank you. And I think to those both of your points actually is that it's a number out there, as you say, Matt. And frankly, even if we're 50% wrong, cool, it's still 20 million,
right?
Thereabouts, so. But I think, as you say, Tim, there is a real hope that, as with all first numbers, that it can be chiseled away and scrutinized and inspected by everyone who sees it, and that we end up with something that just is increasingly reflective, I suppose, which is why at this stage I want to ask everyone on the call what you think. So we have a quick polling question, which is just quite frankly, actually, as you can see here, do you back the 34 million number? So based on what we've chatted about, just if you wouldn't mind just putting in your views, I was just very curious to see. Do we have more people who are in the sticker shock zone, or do we have more people thinking, do you know what, this is way underreported for so many reasons? What does the audience think on the $34 million number? If we can just post those. Generally speaking, we're in the slightly too high bucket. So we're saying that basically, what's that? 80% of people reckon that we're either on the mark or slightly over-reporting. Okay, so that is, I suppose, ultimately validation that there is cause for a conversation here, and so we should carry on the webinar as opposed to stopping here, because basically everyone thinks that we don't have a problem. So thank you very much for your responses to that. A quick question for you, Matt. We talked about the kind of current cost, and I love what you were also saying about the compound effects of like reg cap and so on and so forth. But directionally, do you feel these numbers are going up or sideways, downwards? How do you feel they're kind of tracking at the moment?
I mean, I guess a bit of context, firstly, and I'm sure this is true for most people on the call. I think generally the amount of market activity that we're all supporting is growing, right? Most of our businesses are growing. So as a baseline, my general expectation is that costs will continue to rise. I think the real question is probably less about whether the cost is going to rise. It's more that rate of accrual versus the rate of the business. Now, there's definitely some tailwinds, and I know we'll probably get into these in a later question, but I think we're certainly starting to see the cost of automation is starting to come down, and our ability within the four walls, I think, of each of our organizations to drive automation and drive efficiency is definitely improving with topics such as AI. So that is definitely a tailwind. And I would like to think that will bring that rate of accrual down. The next big opportunity, and again, I don't think we have a clear view on this, is then how much can we start to unlock with bringing more standardization across the market, and how can that start to improve the scale ratio? So if the business grows 10% next year, does the cost base go up by 10%, or does it go up by 5%? And if it's 5% in that example, like that is a win. And I think if we look back historically, in the last five to 10 years, I think the complexity of what we've all been dealing with, the demands from clients, just the sheer amount of volume, like the business has changed a lot, and the scale ratio of cost, I think, has certainly been increasing during that period. So the cost to support a trader is probably grown during that period rather than fallen.
Yeah, absolutely. No, look, and I think I can't wait to drill into a few of those points, especially I think, as you said, the key indicator really is rate of cost growth divided by rate of volume growth, right, I suppose. And it's actually, as you said, it's not the absolute. If you've got any questions on anything that we're talking about today, there's a Q&A function at the bottom. So please make sure you put those in, and we will get to those either during the conversation or at the end. So, Tim, from your perspective, these costs, I think, Matt, if you were going back, you're kind of talking through that ratio, and as you said, we've seen it kind of climbing in the last little while, probably. If you go back, Tim, to your youthful days, what do you think this number was, say, 5-10 years ago? I mean, do you think that we're in a materially better position now, based on a lot of the things that we're talking about from Matt's side in terms of reducing cost of automation and so on and so forth?
You bet. Yeah, Barney. And for the record, I'm still young, Barney. Corporate actions tends to age a person, but probably
you're only 25. Yeah, exactly. This is what corporate actions does.
It'll do to a person. But one of the focuses we have in dealing with the ongoing cost, and it's still surprising, any function in capital markets whose cost continues to increase is against our conventional wisdom. Every other aspect of our business, from executing a trade, confirming a trade, settling a trade, reconciling information, all of these processes have gone down, right, in terms of the overall cost of the firm, corporate actions being an outlier. And one of the suggestions is, how do we start to standardize this from source? How do we interface with the issuers and their agents to capture more information in a consistent way? Today, the depository sets up every new issue of debt and ensures that the security itself is eligible for the depository. It has to meet certain criteria to be eligible. Can we extend that eligibility to the performance of the issuer and their agent in presenting us with more standardized information or more electronic information, faster information? So move the problem upstream, if you will, and require the issuer to have different behaviors that would improve the plight of Matt and those people downstream of us. But the grim reality with that, and the reason that we're going to continue to struggle with non-standardized events, is that investment banking itself will not be constrained by the back office and operations challenges with processing event. So a lot of this is this is capital. This is capital formation. Capital is creative. Issues need to be considerate of the issuer's individual circumstance, the tax implications of raising capital in certain ways, innovative features that security would have that would encourage investors to buy it, frankly. And so with that degree of creativity of tax efficient capital formation, they're never going to be standard, right? So we're always going to have to be coping with a new variant of an old event, if you will. So while we've, to Matt's point, we've automated a lot of the more non-voluntary distributions, I think when it comes to creativity and any rights or tenders or interactions between issuer and investor, we're still going to be dealing with complexity. We're still going to be dealing with non-standards.
Yeah, Yeah. No, look, I think that's a great point, because ultimately, there's I think a tendency very quickly to focus on, the panacea and the kind of this wonderful world where everything is standardized, but ultimately we've got to make some progress in the meantime. And ultimately, I think it comes back to what you were saying, Matt, around, that improving cost of automation, which I think is a brilliant point. Before we get there, though, just a quick question in terms of just the direction of those costs, because I think two things really, Matt, for you. One is that we see your point about the ratio. We see probably brokerages actually struggling the most with that ratio, to contain that ratio, mainly because we've always assumed it's mainly because of the activities that a broker is exposed to, as I said, in terms of prime brokerage, a lot of the funding activity, a lot of structured product activity. And I was just curious if to see if that resonates with you, and also the overlay of T+1 on those activities, because it feels like we've got a lot of messy bits floating around the industry at the moment that could really be aggravating these core costs. I was kind of curious to see if you feel that in the last 12 or so months that there've been a few more headaches in those spaces than before.
Yeah, no, actually, there's a ton to unpack with that question. So maybe I'll start.
Sorry, it's a long question.
Maybe I'll start with the point on T+1, because I think it really resonates. I think what's interesting about accelerated settlement, obviously led in the US and coming to many parts of Europe in the next 2 years. Like, for me, that's really put a focus on operational efficiency, operational processes, and in a way that I just don't think we've seen before. Like, when we get into a stage where settlement cycles are that compressed, like manual processes, manual exceptions, they just don't work, right? So when we think about building a value proposition for why there needs to be investments within the life cycle, I think that's really helped. And when you look at things like fail rates, people getting caught up with like funding cycles, with FX, etc. Like, I think people really learned some lessons as we went through T+1. And I think the firms and the areas that were really successful were those that made the investments in having good, clean, to the extent they can, real-time data. Those that focused a little bit more on automation rather than having some of the more traditional patches in place. So I think as we continue to see things like accelerated settlement across the world, I think it's very helpful for all of us in that it does create more of a spotlight and some pressure to invest, which is great. And then look, I think on the costs, and certainly an area that I've personally been quite focused on, is that, and Tim picked up on this, is there are definitely parts of the business, right, which actually are more vanilla. There's more opportunity to get those automated. So I think kind of differentiating between where is the legitimate, the more complex items, frankly, where some of the alpha is for all of us as operations professionals, right? Where is that alpha that actually you do want people spending some time, right? There is some value to your clients, to end investors through us spending time and that being more customized, versus the areas where you can really, go after and churn the volume. And, some of that comes in the way that we design our processes, that some of that comes in the way that the market operates. But I have to say, I am excited about the opportunity that as this compression comes, like the focus that comes with that. I think if we can really ride that wave as an industry and help that as a catalyst drive change.
Yeah. No, look, and I think, and for me, that kind of follows on so nicely, I think, Tim, from your point, in a world of kind of in a world of capital raising, ultimately following all its way through with all of its complexities and stuff, there is an enormous value in a prime broker and a broker and a custodian being able to really actually add a lot of human intelligence to that, to really actually to be able to actually, as you said, to generate a kind of human alpha. And I think that's I think again is often gets missed, because we often look at just, okay, well, look, frankly, we're just getting more and more manual, that must be a bad thing. It's not all manual is kind of created equal kind of thing. Yeah, absolutely. And so I suppose before we start getting onto the solutions, or starting to position the solutions, and actually there was a question on this, is just, what does this all mean at the end of the chain? So we talk about, $54 billion of costs. We talk about 15 billion of being unavoidable. This ends up basically by hook or by crook. This ends up as basically sitting in a pension portfolio. And I was curious, Tim, just to see kind of from your perspective, when you're speaking to the fund managers that are managing accounts and obviously into the beneficial owners, what does this problem look like for them? Why is this a risk issue? Is this a cost issue? Is it a bit of both? Is it a performance issue even?
You bet, Barney. And I wanted, just before I get into that, I just wanted to compliment Matt on the way he's articulating 2+1. And it's not just a settlement cycle. It's a cultural sensibility change that we will no longer tolerate latency in our processes and operations, right? So it's bigger than just that when we exchange cash and securities. And the old expression, money doesn't sleep, but it sure takes a lot of naps during our processing cycle. And I think that between, accelerated settlement and 24/5 trading, I think we're going to drive a lot of that latency out. And who had the X date, who held the security on X date in a truncated world is going to be even harder. So we got to get tight. So anyway, Matt, I really like the way you described that in a bigger way. But from the direct question, from the fund management community, they're really looking at it in terms of lost performance, or at least those that are thinking in a more thorough way. Missing the ability to tender a position at an advantageous price or advantageous tax treatment, not being able to redeploy proceeds of a distribution, missing that value of money, sleeping money, if you will. Every custodian bank writes checks for losses related to corporate actions in a big way. You said some capital reserves associated with that. Likewise, every investment manager compensates shareholders for operational errors related to the processing of a corporate action. Their fiduciary responsibility to their investors demands that they make the investors whole. Those are the more overt ones. The less overt ones: mispriced securities, failed trades, rejected orders when a ticker or QSIP is updated related to corporate actions, but the system isn't set up to process it. So I think with this dialogue, this research, we're encouraging people to think broader about it in terms of the true costs. But the big where we're writing a check, the big errors, if you will, seem to rise to the top. We all have that experience, and it's traumatic, right? It's like a shark attack, right? Takes a limb. I think most of corporate actions is more like a parasitic, like a suckerfish on you, gradually depriving you of nutrients and robbing you of performance and alpha. And so it's not always these big dramatic events. It's insidious, parasitic inefficiency on our process. And when you add up all those, suckerfish, it adds up. And so I think that's why we're focusing in more detail. And as we get faster, more precise in everything we do, it's time to address these kind of insidious costs.
I've never heard it be called an insidious parasitic problem. That's the most unambiguous sentence I think I've ever heard in the context of corporate action. So, yeah. But so to follow on from that, you give some really good examples about what it feels like on an average day to be a CSD in this mix. The number of alerts that you have to send out, the volume of work that you're doing. What is the CSD's role in all of this? Because obviously the first problem we all have is, massive amounts of intermediation. And everyone's just pointing left, pointing right, trying to blame somebody else. From a CSD angle, where do you feel that you are in the overall change project, if you like?
Well, I think we're talking about really reimagining the way information flows between issuers and investors. The CSD really needs to step it up. And I think there's a big part of this process that we're going to have to own. As we said before, the CSD is essentially the platform for capital formation in public markets. Every new issue needs to be presented to the CSD in order to be eligible for a secondary market for people to trade the security in between brokers and custodians. We also have to process every entitlement, every distribution, every dividend, every right that a bondholder or shareholder is entitled to pursuant to their ownership of the security is digitized and articulated by the CSD. It starts here. So we are the authoritative source of this data, and we distribute billions of dollars in capital every day. So corporate action to us isn't a record. It's the foundation of moving capital to investors, and often making elections that investors have to issuers. So how they distribute capital. So there's a single linchpin between issuer and investor with all of the complex networks that information flows. That single linchpin is the CSD. So we have to get it right, or our investors don't get paid, right? So we see, and it's not just unique to DTCC, we see other markets, our colleagues in other markets, reconsidering this process, accelerating availability of data, experimenting with AI and DLT, and extending their platform downstream to create a better network from connecting. Ultimately, we want to connect issuers and investors and all of their intermediaries in a more cohesive and standardized way. And we think the CSD is going to be a big part of that process, Mark.
Yeah, no, look, and thank you, because I think as you rightly say, I think it's the way I read that is that there's, underneath that kind of banner that CSD has to be there. It's kind of, you've got the technical role in facilitating it. You've also got the kind of the leadership role in terms of driving the industry conversation as well, because there's a whole bunch of things that you don't even control. And I was curious, Matt, from your angle. If we think about the kind of the trickle down, there's a whole bunch of things that a CSD can do, but then there's a whole bunch of weak points along the chain that basically that we continue to, or that would continue regardless of what the DTC does in the States or anyone else elsewhere. How do you see those weak links, I suppose, in terms of where do you see as the really Achilles heel, if you like, of basically of the things that when you look at your business, you're like, oh God, you know what, it's that's really killing it.
Yeah, no, maybe I'll just share every story. So we were at the, I was talking yesterday at I think it was the Corporate Actions Conference in Europe, and we opened up, and we had a bit of a conversation about common problems and where the industry's at. To Tim's point, no one mentioned shark bites or parasitic drains, but the first poll that we had on the screen was like, what's keeping corporate actions leaders awake at night in 2025? And the top item was data, and in specific relation to announcement data. And it was unanimous. Like, there was 5 or 6 things on the screen, and the bar was just maxed out on announcement data and having a golden record of what corporate action should be. And frankly, the mind boggles to be in 2025, and we've got great standards around SWIFT, number of regulations that have gone live over the years, and we're still really struggling with that. And then I think it's fine to pick that up on your question. The challenge with that is that as it progresses through the life cycle, everyone is recreating their own version of the truth. Now, you might hypothesize that means it's getting better as it goes through the life cycle, and in an optimistic world, when it gets to the end investor, it is the best possible record that it can be, or possibly it deteriorates as it gets through, right? I think we can all kind of draw our own conclusions and got our own experience on what the practicality of that is. So it is incredibly refreshing to kind of hear Tim's view around the fact that the DTC and others kind of think that the CSD plays an important role, because I certainly don't see anyone else who is in a position that sits between so many of the different parties to be able to really start to create some of that. And if you think about some of the features that we need, it's not that extensive, right? So having some form of golden record of what a corporate action or announcement is great. Then having some ability to have things like buyer protection, having claim settlement. There's probably 2 or 3 big things that if a CSD could intermediate on those, create some standards, would have a huge impact to all of the intermediaries in the chain. And I think most importantly, just bring consistency to what the end investor is getting. I guess the closing comment on that topic as well is, if you look globally, if you were to pick the best of the different standards that exist in some markets and functionality that exists for different CSDs, and you bring them all together, the individual capabilities definitely exist. Some markets do some things really well, other things not quite as well. So kind of the blueprint is definitely there. I just don't think anyone's yet kind of put it together in one package.
Yeah, absolutely. I mean, Tim, to that point, I mean, things like golden copy sourcing, buyer protection. I mean, what do you see as the kind of CSD getting it right? What does that look like? Not necessarily what's the strategy, but ultimately from an outcomes perspective, what do you think is kind of, a good model, if you like?
You bet. Yeah, and I think certainly we have to accelerate our ability to capture data, ensure that everything we translate from documents is as precise as we can, and that we're transparent about how we do things. I think to Matt's point, ISO messaging has had an impact, positive impact. I think the challenge that we have is just the sheer complexity of some of these events. For those of you in the audience that have operations backgrounds, it's hard to get two disparate organizations to match any type of transaction, even a trade confirmation, Barney. I know you know this world. 6 or 7 fields we have to match. And it's difficult. Now, when you're dealing with a complex corporate action with a lot of different attributes, and some of those attributes contain some, legal interpretation, we're not mapping all of those details into individual fields. And then we tend to dump a lot of this material information into narrative fields, into comment fields, which relegates, a Swift message to a telex, a modern day telex, right? Humans are reading copy, or copy is being cut and pasted through a Swift message. So ultimately, we think, 20022 and market infrastructures are adopting that. We've sent more than 1 billion 20022 messages, DTCC has, in the last 10 years. And we see good adoption between global custodians and sub-custodians at 15022. And so those are making an impact on the non-voluntary routine kind of events. But it still leaves a huge amount of voluntary and other complexities that message standards just simply won't address. We're not going to get two machines on disparate institutions to have a dialogue or reconcile or communicate. AI is not going to do it either. So we got to rethink how we connect people beyond ISO messaging, Barney. And I think that's where the more innovative solutions are going to be created. How do we create networks of communities, not just stitch them together through ISO messaging?
Yeah. And I think, and that's such a great, I think, moment in time description, because I think, if you kind of go back, at least from what we've all been working on, actually, if you think about the amount of time we've all put into ISO 2022 feeds and 1522 feeds before that, I think that the general belief was that standardization is going to crack this one. And actually, as Matt, as you said, in a lot of cases, actually, there's a lot of alpha to be gained from non-standardization in specific areas. But equally, there's also an acknowledgement that basically that we're only ever going to get so far. So should a stock dividend, should that be standardized? 100%. At the other end of the spectrum, the big things, perhaps not. Which I suppose brings us on to the question, Matt. Your comment earlier on, I thought was fantastic, that the cost of automation are coming down. I was just really curious if you wouldn't mind maybe just expanding on what that looks like right now in terms of, in the absence of standards, or rather, actually, we're not short of standards. We've got tons of them. In a world of multiple standards, let's say, you're still obviously chiseling away and making progress and finding efficiencies. What does that look like on the more tactical kind of level?
Yeah, maybe just to share some of the experience with technology over the last kind of 6 to 12 months, where there's just been a huge acceleration, right? Like remarkable. I think we've seen a couple of things. So firstly, for your more, I would call, traditional deterministic type automation, the cost to implement that, as your technologists at the firm are supported by AI type tools, like their productivity is continuing to increase. So your classic type of automation, the cost of that is obviously starting to come down. We can deliver things much more quickly. In some cases, you can have individuals in operations and from individuals in your strats team are actually able to go and generate and commit code without being engineers, right? Which is something which even 6 to 12 months ago wasn't something that I think we would have expected. So I think the cost of your more traditional automation is definitely coming down. I think, and a bit of a debate here as to whether finance is ahead or behind other industries on adoption. But I think as we're then starting to see adoption of tools, I think the ability of some of the tools that are available to do multiple steps has been incredibly surprising. So take an example of, I don't know, we all get lots of emails a day. Those emails will have multiple different attachments, right? Potentially around announcement information. Your ability to digitize those, right, which is one step, like AI is pretty good at doing that. Then there's a next step to actually then compare that information, understand where there might be gaps. Again, AI is pretty good at like aggregating data and noticing anomalies. Then maybe taking that data and where there are exceptions, and then maybe reasoning why that exception might be, right? Maybe it's because of a particular quirk of how one listing works versus another. So if you reflect on what I've just described then, there were three things that an AI tool is doing that if you were otherwise trying to automate, you'd have gone to your engineering team and said, right, I've got three separate requirements. I need you to make me a tool which is going to go and digitize email. I need you a tool that's going to go and like compare. I need a tool that needs this. Suddenly, like your engineering team haven't got to do any of that, or maybe it's just they do one thing, right?
Yeah.
So there is definitely a little bit of a multiplier effect here, I think, in terms of like what the opportunity set looks like, right? We've got more tools, and even for like the tools that we had before, the cost of implementing those is certainly starting to come down, and that's important because we describe AI as a hammer for a moment. There's a risk in the short term that everyone goes around with a hammer and tries to hammer everything, right? And actually, like there are going to be examples where we don't need to use the hammer, or actually using another tool in the toolbox is the appropriate way of doing it. But I think all the tools in the toolbox are going to start to reduce. So, like for me, it's not really a question about like, is it going to bring the cost down? Is it going to transform the industry? Like it absolutely will. It's just a case of how quickly we all adopt and we deliver it.
Yeah. But I think that's really great. Because for me, I think, again, if you look at the solutions that we've talked about for the last however long this is, standards, but also like big system lift outs, big system deployments to kind of doing this thing, a lot of which basically often struggles to get across the line in terms of actually generating the kind of difference that it needs to, because standardized stuff just sometimes doesn't happen. So the way I hear what you're saying in terms of putting the innovation much more around the user, the business unit, enabling them to be able to actually come up with their own answers, that this becomes a patchwork quilt savings, that essentially if you're more able, each of us is more able to build solutions that really matter for us, with AI fundamentally in the back pocket, then you can take control of this and actually you can chisel away at it more effectively. And if Tim does his job, as he was saying, in terms of publishing things, sourcing information faster, more accurately, and being able to pass those down the chain with less risk, then ultimately you end up with a patchwork quilt of everyone being able to kind of, chisel away at it. So it's not about the big golden answer. It's about many, many people working more effectively. Yeah. And thank you for using the AI word. Obviously, it would be impossible to do a webinar without mentioning AI. So we're going to skip over DLT and tokenization, actually, because we've got a couple of questions that I want to touch on. One for you, Tim, actually, is just I thought a really interesting one about the lengthening chain of intermediaries here. We've kind of assumed it's static, but of course, as you get more and more cross-listing, as you get things like securities being tokenized by Robinhood, for example, you get ETFs. Obviously, you've got a lot of areas where actually one corporate action is getting more complicated and going into more omnibus accounts and so on and so forth. I was just curious, do you find that, from a CSD perspective, do you feel that it's getting harder and harder to the increasing intermediation is a problem ultimately?
Yeah, and I don't know if you're wrapping that in a DLT question too, Barney, but
sure, why not?
I mean, you got every webinar you got to talk about AI and DLT.
I was going to say, let's do the bingo thing.
Yeah, I got to take that on. But listen, I also admit I'm on my own personal journey to understand digital assets. Some kid called me a TradFi guy, which I'm pretty sure is a pejorative in the digital asset world. Basically call me grandpa. But I do remind him that the TradFi people are funding the DeFi adventures, so have some respect here. But it's a really, really interesting space. And you mentioned tokenization, real world assets, and many of you probably saw a NASDAQ announcement a couple of months ago that they're going to issue, tokenized representations of equities. Those equities are going to trade alongside the traditional CUSIP. So you have tokenized representations and non-tokenized representations trading in the same limit order book, and then on down to the depository for settlement. So, fungibility between tokens and real world assets is going to be possible. It's getting real. And it's coming now, and we're investing heavily in this. So what's the point of putting this on chain? I think it comes back to your question, Barney. Putting real world assets on chain opens up opportunities via things like smart contracts. Smart contracts contain executable instructions that tend to link processes like payments and distributions and lending recalls. All of those can be programmatically contained within that smart contracts. And as we talked about, the whole basis of this webinar and the research, corporate actions is an interconnected process to other things. So the more you can trigger other impacts from a corporate action embedded within a smart contract, there's not a magic sync button in the enterprise that does this. So we think smart contracts may be the nexus of that synchronization. And then in the future, issuers will issuers will put their new securities directly on chain. Which, like in terms of a debt issue, a smart contract will dictate accrual methods, semi-annual, monthly, daily, whatever you want, hourly. So the smart contracts can fundamentally alter how investors participate in a company and how corporate actions and distributions will be baked into that token. So in the short run, we think DLT can improve how data flows. In the long run, it's a digitally native tokenized representation is going to change how corporate action information flows to investors. So yeah, is DLT going to have a big impact on this industry? Big time.
So which makes sense, I think, from a broad perspective. I suppose for me, as I was listening, the one banana skin is the standardization, as you were saying, is just this idea that and I was curious, Matt, from your perspective, and I hope this isn't stepping too far, but essentially, you've got an investment bank in the same building as you, basically going away and saying, right, we've got this new amazing corporate action that's going to be fantastic and it's going to, do all these wonderful things. And at the same time, you're the guy who's obviously struggling and dealing with it on the back end. I mean, I was just curious to see really how is there any reconciliation, at least in terms of slowing? Do we believe that there is any way of slowing the growth of kind of complexity? Do we just take it as a given? What's your take in terms of just that constant desire for variance? And I mean, do we just live with it?
Look, I kind of comes back to the opening statement when I commented on the dollar number. I think some of it's unintentional. There's just not a realization actually of the impact that it has down the chain. And I think some of that really comes back to us as market participants, in that we haven't necessarily been able to describe it in a way that's meaningful.
Right.
I mean, I think Tim put it pretty eloquently earlier around the fact that people do, when there are significant risk issues, something goes wrong, like, people tend to notice, right? But it's just that ongoing drain. It's not necessarily clear. And then when you think about all of the other elements that would go into structuring a deal, regulatory compliance, delivering what the issuer is looking for, there's a ton of variables that go into it. So I think, how do we continue to turn the volume up on this particular angle and make it meaningful? Like, for me, is really part of the opportunity set here. I would also maybe just go off questions to pick up just on a couple of points from Tim on DLT. So, like, the upside and the opportunity set there is incredible, right? Like, if it goes well and we get what we would want within the smart contracts, like, it could be incredible. I think the downside here, taking a potential pessimistic view on it is there's a risk that we fast forward and we were having this conversation again in like 5 to 10 years, that we find ourselves in the same place where actually potential is there, but the decision hasn't been made to incorporate smart contracts around voluntary events, or there are certain elements that don't get put in, or the source data that's actually going in as it relates to corporate actions and asset servicing doesn't make its way in a consistent way, which then kind of means like the problems that we're living with now in the cash equity bond fund world, like you could foresee them living in a DLT world. So I think like we've got to stay focused on that and hold the course in making sure that like the core objective of DLT as it relates to securities is delivered, but then also like these other important post-trade services are like part of the conversation, and critically actually make it into the final builds, right?
Yeah, absolutely. No, 100%, absolutely. And I think, yeah, absolutely. So look, a few minutes left. I was just thinking to kind of, so obviously the big question is 2020. We're on the verge of a new year. The big thing that each of you would do, but maybe just before we kind of just get your kind of 1 minute view on those. A couple of clarifications on the data that have come through. The numbers that we ran through are all events in the US, so not necessarily just voluntary. And they also don't include data licensing costs and all the reconciliation costs that go with that. So, there are, areas of underreporting. But I think back to your point, actually, Matt, I was just writing down, actually, for me, the thing that never occurred to me, the biggest investment banking advisors are also the world's biggest prime brokers and custodians. And it's an interesting, as you said, that are we having that conversation? For me, the thing that I always think about is that I don't think that the portfolio manager at BlackRock ever tells the investment relations guy at Coca-Cola that their corporate actions are rubbish and that they're going to kind of blacklist them. Nor does probably one side of the prime brokerage speak to, the merchant bank or the investment bank speak to the asset servicing guy within the bank. So those telling the story points, I think we're probably getting a little bit better now than we used to at knowing where those conversations play out. So closing comments then. So Matt, maybe first of all, 2026, got to get the year right. Big things that you're looking at in terms of trying to make a dent in that $34 million number?
Well, I think firstly, based on this conversation, I'm very excited about what Tim is delivering.
It's all on you, Tim.
Since in the absence of utopia state on announcement information. I mean, look, it's definitely, I would say it's a continuation of the journey around we're going to be continuing to focus on what we can control around automation. Like I'm incredibly excited already with what we've seen with the capabilities of some new technology, and particularly around the speed that is able to deliver change, to deliver automation. So we're going to absolutely continue on that journey. And then in addition, really just on the market advocacy side, this is a great conversation that we're having here around the US with T1 coming in Europe. Like that is definitely an opportunity to re-engage on what needs to happen in the corporate action asset servicing space. So that's an area where we're going to be spending a ton of our time.
Fantastic. No, thank you very much. Tim? Real quick. I know where time. Real quick, Barney.
Listen. The whole AI. I just want to mention that this is going to be in 26 going to be a big topic, and it's not just capturing data from PDFs using AI agents, but imagine getting the entire universe of corporate action events normalized, cataloged, captured in modern environments like Snowflake. Being able to apply like co-pilots and agentic applications on top of that universe of data, allowing a user to literally post any natural language prompt against it. So meaning from an operations perspective, tell me about the issuers, agents, and counterparties that have a history of operational challenges. I want to keep my eye on them. From a front office perspective, tell me about the issuers that consistently beat industry estimates on distributions, et cetera, or how underlying asset-backed pools are performing in terms of how they're distributing interest. So in the future, you don't need to be technical. You don't need to know Python. You only have to have your own curiosity with an AI layer on top of a normalized data set. The data's got to be there, right? So in the AI wars will not be fought over models. The AI wars will be fought over data. You don't go to war over engines. You go to war over data or over oil. And that's what I think. That's where what this data is going to be so powerful with AI on top of it. We're going to be able to see new things we've never seen before, and that's coming very soon. Anyway, thanks, Mark.
No, thanks. And I think that's a great ending point, because I think ultimately, as you said, there are new tools coming to the fore that basically, even if you stay in the kind of the world of just using them to read docs, we're talking about chiseling away and just an exponential path of benefits that seems, and all the early proof is that basically is that is basically worth our time, worth our money, and that ultimately it's going to create that kind of patchwork quilt of benefits. So look, I think to the point of this conversation at the beginning, the aim was obviously to really help tell the story, help everyone on the call to be able to actually have that conversation with their colleagues, counterparties, and management. So thank you so much, Matt. Thank you, Tim, for really setting it out so clearly. If anyone does have any questions, reach out to any of us. As you can tell, we love talking about the topic. And as I said, it's a real, very exciting point to end off, I think, in terms of, Tim, what things will look like in a year's time. So thank you both very, very much.